Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I have two paper money trades for you today on two high-profile names. We'll look at Tesla and we'll look at Google Alphabet. Both names have sold off significantly and on a technical basis are oversold. Doesn't mean they can't go down more, but they are oversold right now. But let's look at strategies for both of these. Remember, these are paper money. Now, first in Tesla. Tesla is moving a lot, as you know. And so the paper money trade to look at, and this is for learning purposes, something you can look at, is the 1/2 back ratio. Now, what does that do? You sell a call, buy two other calls against it. So you're short a call vertical and long an extra call against it. I'll show you what I mean. In the March 14th expiration, so as you can see, I give myself 15 days for this to happen. I sell the 270 call, and then I buy two of the 300 strike calls. And what that does is you do that for about a $5.30 credit, okay? Now, I put that in at $5.30 credit. It's trading pretty close to a $5.30 credit. Now, what does that do? If Tesla were to move down with the break even around 275, right around that, or 275, it's profitable below 275. It's also profitable on the upside. If you get through the, the higher levels. What you are? You are short a call vertical and then long an extra call against it for a credit. So it's profitable on big moves in either direction. Where's the risk? Right at the 300 strike is where the max loss comes in because of the short call vertical would go to full value and the long call would go to zero. Right? That's where the risk is on this trade. A big move in either direction is where this is profitable. And by definition, the P&L on the upside is infinity because you're long an extra call unit. So if you're looking for a big move in Tesla, this would be the way to do it. But it's the loss, the risk on this trade is no movement in Tesla over the next 2.5 weeks. Okay, there's the trade in Tesla. Now Google Alphabet. Google Alphabet, we're going to keep it a little more fundamental, and that is looking at where this is. I went out to the March 21st expiration, bought the 175 call, and then went into next week's expiration, March 7th, and sold the 182 call in line with the expected move for next week, although the stock has moved lower than it was previous. So can you move your strikes? Yes, you can. I put this in originally around $4. It's trading less than $3 now, as when I put this in, it was right after the market was open and Google Alphabet was actually higher on the day. Now it's lower on the day, and this spread is trading a full point lower than it was earlier this morning. So, but the strategy is buying a relative at the money call March 21st with 22 days till expiration and using that March 7th expected move, a little over $7. I've got it $7.16 in either direction. And there's setting the price of the short option. So if you want to move it to 170, 177, you can. 170, 175, yes, there's another way to do it, although that's inside the expected move. But this is a call diagonal in Google Alphabet, buying the March 21st. In this case, it's 175 and selling next week's expiration 182 call. And the risk on the trade on a diagonal spread is the debit paid. All right, that's our trades for today, everyone. That's our show for today, everyone. I'll see you next week with another edition of Daily Trader. I'm Kevin Hincks.